I'm Chris Preston.
And I'm Brad Simmerman.
Welcome to Street Check, the best podcast in the history of Cabot Wealth Network, which has been in business for more than half a century. Brad, before we get into our usual rundown today, you are coming off a trading story nightmare from yesterday. I'll let you just explain what it is. There's a lesson in here, but just explain what happened yesterday.
All right. So we saw the biggest one-day reversal in 2 years yesterday, and I
In the S&P
closed
or
in the
in
S&P,
indexes, yeah.
and I closed out what would have been a 10-bagger trade about 3 hours too early. So 1,000% one-day returns. And there are three cardinal rules that I broke. One is don't fight the tape, right? Don't fight the trend. Uh, Two is don't call tops and bottoms, right?
Mhm.
Sort of a fool's errand. The third one and the biggest one, which is the one that actually prevented me from executing a profitable trade, was invest with conviction or don't invest. Uh, Tim used to talk about that. Um, I don't normally trade like 0 day options. It's way too close to gambling and you can't really there's no fundamentals. It's entirely based on what like the market's reaction is going to do. But I opted to take a flyer because this market has felt overvalued for a while. It's kind of disconnected from fundamentals. So I was sort of, toying with what would be called like piker bets, small stakes trades. Happened to be on the exact right side of it at the exact right time and get out a few hours too early. The lesson that I took away from it is match your trades with your personal comfort level because it stings, right? No, yeah, like
Yep.
busted trades is like talking fantasy football, right? Nobody wants to get too in the weeds, but
Yeah.
I had, what looked like worthless SPY puts that I just closed out early in the day because I didn't want to babysit them instead of submitting do not exercise instructions to my broker, which is what I should have done. And they alone would have like been 20 times their value at the end of the day. Now, right, it's not a system, that's not a functional system thing, right? Like it's not a trust the process thing because it took the biggest reversal in 2 years
Yeah.
for those to be in the money, right? Like the system thing that I did was correct. But the thing that got me was not having the conviction to just let a trade play out throughout the day,
Right.
even though it's something that I've been watching very closely for a number of weeks now.
Yeah. I mean, I guess this is why, Jacob doesn't do a ton of weekly options trade. I mean, this was even shorter than that,
Yeah.
but yeah, yeah, you're right that it took a huge reversal, biggest, what you said, biggest reversal, 1 day reversal in 2 years, something for it to
That's
happen.
Yeah, that's
So
the headline I saw.
not egregious. I'll give you I mean, if you trade long enough, invest long enough, you're going to have some of these, and it's usually missed opportunities. Mine, I bought Nvidia in late 2017, got shaken out of it, which is code for I sold too soon. In 2018, maybe it might have been early 2019, it was down 20, 25% or something. And I never bought it back. So that would have been a nice stock to have now, as we
Yeah.
talked about literally an Nvidia market for a while there. Maybe not so much now, but yeah, everyone's going to have some of those. As long as you're not, it's better to miss an opportunity than lose a lot of money. But
Yeah,
opportunity
and
cost, yeah, it's a tough one.
all you can do is break the rear view mirror, right? You're not always going to get every trade exactly perfect. And then looking back at it doesn't help. But use it if you miss out on one, refine your system, right? At the very least you walk away with experience. What are you going to do?
Yeah, yeah, every
Still
loss.
stings.
Yeah,
Would have been driving around with a nice new used car or something like that had it
you wouldn't
happened.
be here today. I'd be doing this solo, I think.
I wish it had been that big of a trade. No, it was small stakes, but
Yeah.
would have been a nice payday. Uh,
Okay, well, let's see if we can make others money today.
yeah.
Brad, tell people what we're going to talk about today.
On our big three this week, we are going to talk about Tesla deliveries falling short. We're going to talk about the everything rally that we've been experiencing for the last, well, let's say, a month or so, if we go back to when oil started really picking up and gold started picking up. We're going to talk about clever ticker symbols. That's loosely inspired by the ticker change of uh, DJT. And then after that, we're going to talk about leveraged funds and leverage investing, which has been a popular choice for retail investors lately, but carry its own unique set of risks.
And as always, we'll start with defend the take, which you're up for today. And your take, for which you have 90 seconds to defend, is that the correction, the market correction that people have been bracing for has begun. And investors should look to round numbers, S&P 5,000, NASDAQ 15,500 for support. Go.
Okay, so like I said, I've been looking at this market, seeing it sort of overvalued and trading irrationally for a while. If you look back to November, I'll look specifically at the S&P. We've been in essentially a straight up rally since November, so we're going on 5 months right now. There's not really been any kind of meaningful retracement, but what we saw at the beginning of April, we saw that gap down on overnight between the first and the second. And then yesterday's trade, that big intraday reversal, actually brought it below its 20-day exponential moving average, which had been a really resilient support line going back for the duration of that 5 months. And it looks, the market has felt toppy for a while. People have been ready to take profits, and we've seen some increased volatility. VIX up to 16 or so intraday, and I believe was even higher yesterday. So I do think that we've entered the correction, and if you want to peg it to a high point, it was probably around March 21. So we're actually probably about 2 weeks into what I think is going to be a correction for us. The numbers that I'm looking at for possible downside targets, 50-day moving average is about 5,100 on the S&P, but that's been untouched since November when it broke through it and then briefly retraced to that levels. What I'm really looking at is a gap closure going back to the last week of February. The S&P gapped up above the 5,000 level and has stayed above it and hasn't come back and closed that gap at any point since then. So with the 20-day EMA sort of being invalidated on both the NASDAQ and the S&P, and depending on how today's trade plays out, it looks like that is going to be, it looks like that was overhead resistance. I'm looking for it to close gaps. So I think our correction has started.
Okay. Yeah, I mean, I think so. Mike Santolo, who we had on here last week, if you missed that episode, I highly encourage you to go back and listen. He's so good on all things market timing, and growth stocks. He's been talking about, he'd been seeing it under the surface
Yeah.
among growth stocks, right? That, there'd been this rotation. So the indexes themselves were still holding up well. But the growth stocks that for really the last month or so have been sort of stagnant to now probably down. And now I think we're seeing it, catch up to the rest of the market. But as he said, pullbacks like this are healthy for the market, also, especially after 5 straight months. There's only, what did we say last week? The 30th time ever, or since 1950, that the S&P was up 5 straight months. And on average, the next 12 months, if it holds form, almost overwhelmingly, the form has been that the next 12 months should be positive, maybe better than average. I think I said last week is like 12% plus is the average over the following 12 months after a 5-month winning streak. But it's not going to be a straight line. You need pullbacks like this. And I think this is healthy for the market and not something to fret too much about, even if it, continues to go even lower in the next, couple weeks.
Yeah. And I mean, like, this is why you don't call tops and bottoms, right? Like, what I'm looking at from a technical standpoint could be invalidated later today. If
Right.
if the S&P rallies strongly and like closes above 5,200, the sort of correction thesis is largely out the window. I don't I don't anticipate that because, and I think we'll get more into this with the everything rally discussion. Um, the market has been, or the narrative has been rate cuts coming, rate cuts coming, rate cuts coming. And now we're starting to see evidence that the economy is too strong to support that. Uh,
Yep.
and yeah, I'll save the rest of that comment for when we get further into the everything rally. Uh,
Yeah.
but you need corrections. You need something to shut up the bears, right? Like I can't be on here saying everything looks overvalued nonstop for 5 months. Uh, you have to shut me up somehow, and you shut me up via a correction or some consolidation where we get some time for the market to digest some of the gains. Because I mean, there is a psychological element to investing, and we'll talk more about that too, actually.
Yeah. And been saying that things, while strong bull market, things didn't look necessarily overly frothy. And this sort of follows that, when things are frothy, there's no downturn or stagnation in growth stocks that we've seen for the last month. This sort of supports that theory.
Yeah,
Okay. Sorry.
part of it is if you are, if you're leaning heavily into momentum, momentum begets momentum, but if things get dicey, there's nothing there to stop the market from reversing course, right? If you're basing on valuations, as stocks get cheaper, people think, okay, well, the valuations are more favorable and you get buying pressure coming in. But if momentum runs out, you're just sort of like, okay, well, who's the next buyer? And
Right.
it's a frothy market is very susceptible to everybody just sort of deciding, oh, well, it's sort of turned around. I don't really want to be the buyer here. And that's where you get gaps and what Mike calls air pockets. So I think we were maybe setting up for that. And if we got a consolidation here, it takes us down to maybe like the 20-week moving averages, like the 20-week exponential moving averages, which on the NASDAQ is around 15.4, S&P somewhere above 4,900. I think that probably shuts the bears up and gives us a little bit of breathing room.
Yep. Okay, let's move on to our big three. Let's start with Tesla. Um, Tesla just released its delivery numbers for, was this the first quarter or March? I can't.
Quarter.
First quarter, yeah. Sorry. Which were down 8.5%. Deliveries were down 8.5%. 387,000 versus 433,000 a year ago in the first quarter. First delivery decline in 4 years. Tesla stock had already been down. It hasn't, you know, taken on the chin the way you might expect. I think sentiment was already sort of against it. But just thinking about what this means for Tesla, where Tesla is as a company now and where the electric vehicle sector is. I mean, we've talked recently about how, and I in fact wrote this week about how hybrids have become more popular lately. It's sort of, people try to get a foot in the door. They don't want to go full. They want to help the planet. They want to some sort
Save
of
on gas.
what's that?
They want to save money on gas.
Save money on
They
gas.
want the one thing with the hybrid is it doesn't offer the maintenance benefits that the full EVs do because you have like the normal maintenance requirement of internal combustion engine, but that seems to be sort of a marginal cost to them
Yeah.
that is not a focus for most investors or for most car buyers because most car buyers are going from internal combustion to a hybrid. So it's not like they're enduring additional maintenance work and time and cost that they weren't already. But
Yeah, and so hybrid sales were up with 66% last year versus electric vehicle sales are up 47%. This is in the US. 47% is nothing to sneeze at. But hybrids are accelerating, sales are accelerating faster. And electric vehicle stocks have really stagnated, including Tesla, and now we're seeing that their delivery. I guess my question is, do you think there's more a Tesla problem, an EV sort of at a crossroad, EV sector at a crossroad problems, both? Or what do you think this is?
I'm reticent to be overly critical of Tesla like the stock. or Tesla, the company that, they just rolled out the demo of full self-drive. And maybe that's a game changer. I don't have a Tesla. My brother does. He was testing out the full self-drive. His fiance hated it. She was pretty nervous letting the car drive itself.
Mhm.
But maybe she's the exception and not the rule. And maybe the month of free
I was
full
nervous
self.
letting when I test drove a friend's. Yes, I
Yeah.
can relate.
So maybe a month worth of free full self-drive is enough to be like a major revenue driver for them. Maybe they find 1 million or 2 million people that are willing to pay $1,000 a month or whatever their price point ends up being for it. Because I have to imagine that they're not going to launch a free month and then just charge you whatever their normal price is. I have to imagine they're going to have some sort of promotional offer or something after that. But I do think that the evidence is starting to bear out that we pendulum swung too far on EVs, just
Mhm.
as an investing public, as a society, where it's like, oh, these benefits are great, so good for the earth. It's like, all right, well, yeah, but you still need nickel and cobalt and lithium. Um, there are legitimate concerns about range. There's concerns about charging. There are difficulties with long distance travel, right? Like there are problems with it, and I think we swung too far in the pro EV direction when in hindsight, like the hybrids are sort of the best of both worlds, or at least a reasonable stopgap until one, people are comfortable driving EVs as their primary daily driver, and two, until we have better charge infrastructure. And I mean, that discounts the reality that most people drive like 20 miles a day. But if you're on a battery EV, especially something you can plug in overnight, you're
Yep,
getting the benefits of the full electric, which is you
exactly.
don't even have to use the gas. You just plug it in.
So
Go ahead.
yeah,
Yeah.
go ahead. Go ahead.
Oh, I was going to say, and so you're getting the full benefits of the plug-in EV, but you're not sacrificing the possibility that you and your family are just going to all pile into the family truckster and drive 500 miles to Wally World or whatever.
That's an old reference.
This is
Yeah.
a genius reference.
Yeah, it's great. So yeah, I mean, I think I've talked about this on here. We have a Volvo XC90 hybrid plug-in that my wife drives to and from her job, which is about 20 miles away. And it gets in the winter a little over 30 miles um, electric, and I think in the summer it's more like, or in warmer weather it's like a little over 40. So she has to fill up her gas tank like once a month, and that's if we drive anywhere beyond that, because she just
Yeah.
comes home and plugs in overnight. So yeah, you're right. It gets the same benefits as if you have an electric car, except on, road trips. And I think that a lot of people think the same way. I mean, just to add some more numbers to what I said earlier. So now 10% of all new cars purchased in the US last year were hybrids versus 7.6% pure electrics. So the difference isn't huge, but it does seem like hybrids are accelerating more. They did accelerate more last year. Like I said, I think it's 65% versus 46%. Whether that continues, we'll see. Maybe as time goes on, people will wrap their heads around going full electric more. But it does seem like we're at sort of electric vehicles had the romance phase, and now sort of the reality that, another Tim Lutz special that, we've preached here at Cabot for years. The reality is that not everyone's ready for an electric car, and Tesla's feeling the brunt of that. And if Tesla's feeling the brunt of it, then just about everyone else is too. And that's why, we've seen, um, we're probably going to see consolidation in the industry.
Well, yeah, and I mean, if we have continued, higher than people expect inflation, and it gets tougher to budget for a new car payment, you're going to pivot to used cars, and you're probably not pivoting to a used electric, because then you've got the battery replacement cost overhang that's above your head. There's one chart I keep meaning to mention this. I don't think I ever have. Do yourself a favor if you're listening. Pull up a chart of the percentage of people that are left-handed. There's a specific timestamp on this, and I don't know what it is, and maybe I'll search for it if Chris goes on a jag about something. But it's
Yeah.
essentially a hockey stick, basically from when society said, okay, well, some people are left-handed. It looks like a hockey stick. It looks like exponential growth, and then it naturally plateaued at like 12%. it is important to consider what like the potential terminal rate is anytime you've got these exponential growth trends. It is possible that there's a natural terminal rate for like EV ownership in the US of about 10% of people or about 20% of people. So what looked to us like exponential hockey stick growth in the early years of EVs may just be a natural plateau that sort of aligns with personal preference and the individual realities all sort of consolidating around only 10% of the population is really going to be big into EVs. And that could last for years, right? Like we could
Yeah.
just be facing a normal plateau for this. And I,
Hard to
but
change habits, completely when all people have known is the combustion engine for, since cars were invented.
and where, I mean, like the question is like, where are you asking people to make material sacrifices when they're on an EV? You're not asking them to make a sacrifice when they're plugged in overnight or when they're plugged in at work. The one place where people are going to see real changes to like their daily habits, or even not even daily habits, monthly or weekly habits, is long haul, right? So you're saying, okay, the worst part of your family trip, the one that takes 13 hours for you to drive to Florida to go to Disney, we're going to make that 45 minutes longer because you have to sit in a parking lot and charge your EV. Right. So there's a disproportionate impact in one place. That's the only place people are really feeling a major difference. And, there's the cost savings with maintenance, but that's not nothing. And it's certainly
Oh,
enough to sour people on EVs. We might hit a terminal rate on it. And maybe 50 years from now or 20 years from now, that terminal rate's higher. And maybe we see new growth because BYD comes in with an $11,000 electric car that, serves people's needs better at a lower price. But, my fear with Tesla, I'll leave it at this, is if the market ever re-rates it like a car company, that's bad news. If they ever start valuing Tesla like GE or Ford, I will say look out. So
yeah. And one last point is until the charging network, so there's a the number of places where you can charge your EV is, even half, or not even half, a quarter of what the number of gas stations that are out there. People are going to have a natural fear of, am I going to be stranded
yeah.
somewhere if I go on a long road trip if I have an
And
electric
it's
car?
not like AAA can bring you a gallon of battery, right? Like if
Right.
you break down on the side of the road and you have AAA, you can get a gallon of gas from them, or you can walk to a gas station. If you've got an EV, you're getting a tow.
Right.
We got to move. We got to move
Yeah,
on. This
let's
is
move
going
on.
longer than
Yeah, number two, everything rally. I think I saw this was coined, or at least I'm sure other people have said it, but I saw Ford O'Neill of Fidelity. He runs a Fidelity portfolio. So in an interview with CNBC, said this is the everything rally, and what he meant was stocks are up. At the time, they're all-time highs. Gold way up, all-time highs. Bitcoin all-time highs. Oil is up. We're getting near $90 a barrel. Everything is up. The last couple weeks in the for stocks notwithstanding. What is sort of why would you say that there are, because usually gold and stocks are two things that don't go up hand in hand, those in
yeah.
particular. Gold is usually a hedge that people pour into and when times are tough in the market or in the world. Early COVID, people poured into gold. Why do you think it is that everything is up right now?
So I do think that this is the psychology thing that I alluded to earlier. Um, right now, oil is 87 a barrel. At new 1 year highs.
Mm-hmm.
Um, we're in a period where you can sort of make a bull case for everything, right? If you're an equity investor, you can pin your hopes on the Fed lowering rates, right? We're coming off of 2 years of a bear market or stealth bear market. You can pin your hopes on AI driven gains in earnings and improving earnings in general. You can build momentum there and drive equities higher. On the flip side, if you are worried about inflation being stronger than what people are giving credit for in the markets, you can buy things like gold, you can buy commodities, you can buy oil, and we haven't had a point yet where push has come to shove between the disparate elements. because up until I think this point, I think that's part of why we saw the market reaction that we did earlier this week when one of the Fed members came out and said, well, we might not cut rates at all. You've been able to sort of smooth over that, but I think we're seeing some push come to shove when it comes to the real world impacts of if inflation actually is higher, where you've got rising commodity prices, where that's maybe crimping the supply side a little bit and it's crimping profitability. Um, but for the last 5 months at least, you could make a strong case in either direction, and that without your Venn diagram overlapping, right? You could make a case for oil without really raining on the Bulls parade when it came to equities. And I do think that we're getting to that point, though.
Yeah, one of his, we're in the sweet spot of the Fed's long discussed soft landing, but we're sort of in between. There's the hope of, rates coming down, which they've indicated they will do starting at some point this year. But then there's still and that's driven stock prices. And Bitcoin usually goes up along in tandem with stocks during bull markets. But then there's still the fear that comes with inflation still being sort of stubbornly high. Fed hasn't cut rates yet. Economy, while concerns over a recession have basically faded, there's still maybe a small portion of that out there. I don't know, but maybe that's what's propelling gold partly. We're sort of in an in-between phase here, and maybe once the Fed starts actually cutting rates, maybe gold prices will come down. I don't know. I'm just sort of spitballing, but that's sort of my theory, is that we've seemingly achieved the soft landing scenario, but we're not there yet. And so that's sort of lifting all boats right now.
And you had a lot of people calling for recessions in 2022, 2023. There were people calling for recessions that were going to be a year out. You had the yield curve inversion, which is traditionally a predictor of the recession. That seems to not have played out as as an accurate prediction, at least at the time being. So there's a lot of room for optimism where investors can go out and say, look, the talking heads have been saying we're going to run into a recession in a year for 2 years now, and we haven't done it. There's something they're not seeing. So I do think that that a lot of it is sentiment driven. It's largely AI driven, and we are also at sort of a sweet spot where you don't have to prove that your AI actually improves profitability yet. You just had, or maybe not so much anymore, but for the last year, you just had to say, hey, we're doing AI. And that was enough to give you a stock price bump. I hope we're sort of going to resolve this question in a constructive way where everybody's a little bit wrong, where, maybe we avoid a recession, but the Fed only cuts rates twice and equities cool down a little bit. And then commodities, they run up a little bit through the summer and then sort of top out as inflation continues to moderate. Like, there is a sweet spot that is the soft landing, but we're 2 minutes to midnight on that. We need to start seeing evidence of that playing out that we're not quite seeing yet. And it's enough to raise questions, I think, for a lot of investors about whether the narrative that is driving the market is actually going to play out as expected.
Right. And that's what seemingly is weighing on stocks the last couple of weeks, or, growth stocks, maybe more like the last month. Okay. Let's move on to number 3 in the big 3. This is a fun topic, and this is your baby, so I'll let you mostly cook on this. There's a study, couple studies, that clever ticker symbols, stock ticker symbols, tend to outperform the market by a pretty wide margin. So what I mean by clever ticker symbols, so like Dave & Buster's, play is their ticker symbol. For Papa John's, it's pizza, or PZZA. Yum, for Yum Brands, which owns KFC and Taco Bell. Others?
And Pizza Hut.
Pizza Hut, yeah.
And they used to have a stake in Pepsi.
Right.
But I think they divested of that. Or no, they were previously owned by Pepsi. I don't remember
I don't know.
The exact structure.
Love, LUV, Southwest Airlines. I don't really know what the connection is there, but it works for them.
It's their branding thing, right? They've got the heart thing is their logo.
Yeah, I guess it's been a while since I've flown Southwest. They didn't get some great press. That was what, a year or two ago. So yeah, go ahead with this. Should we invest in? Should you have clever ticker symbols in your stock portfolio? Given, I'll let you outline the difference in returns.
So the two studies that you mentioned, Princeton looked back in 2006 at the performance of IPOs that had what they deemed clever ticker symbols versus non-clever IPOs, and found it could contribute between 10 and 30% of outperformance. This was in '06, and then Pomona did a follow-on review in 2019 and expanded on Princeton's thesis by looking at long-term performance of clever stocks. They found that over the long haul, the clever tickers returned 13.2% annualized versus 4.9% annualized for a broader portfolio of stocks. I will note that there's a selection bias built into it. One, they prioritize the Nasdaq because Nasdaq supports longer ticker symbols, so 4 or 5 character symbols versus the NYSE, which was 3 characters. And there's also, because a lot of them were, it was sort of a newer phenomenon. Some of it is just, all right, you're buying growth stocks that are outperforming, so there's going to be a bias there that leads to disproportionate returns as well. But that's pretty significant, and I do think it helps to reinforce something that we were talking about earlier, which is the psychological impact or the psychological questions when it comes to investing. Attention is an asset class, right? We're seeing that with DJT right now, right? It's not a profitable company. Obviously, it's got a large individual shareholder, but it's memorable. I would never buy DJT stock, but I will never forget the ticker symbol. There's a marketing element. Investor perception ultimately matters when it comes to returns, and having a clever ticker symbol can be a minor differentiator. If you're bullish on the entertainment space, it's much easier for you to remember to go and buy stock and play than it is for you to remember to go buy stock in some competing company. I don't know what. Maybe that's not a good example. Or let's say airlines, right? UAL, United Airlines, makes sense, but it's easier to remember LUV. So
Yep.
there is a boost to it. Would I buy exclusively IPOs that have clever ticker symbols? Probably not. But if you are agnostic on a sector, if you're bullish on a sector but agnostic on companies, there's maybe a case to be made for targeting the one with the most clever ticker symbol.
Yeah. So you look at we'll pull up LUV here.
Now,
Performance.
the problem with LUV is they had to reassess all their financials because of the Boeing thing. So they're
Yeah.
probably an outlier right now.
Yeah. Probably not a
They
great example.
the studies used a portfolio of 22 companies and found that 19 of them outperformed the broader
Yep.
market, and the portfolio as a whole outperformed by, as I mentioned, just over 8% a year. So I think that you could probably, it shouldn't be the deciding factor, but if you're choosing between two companies that have identical fundamentals that are in the same sector, pick the one with the smarter ticker symbol or the one that's more memorable, because other people are going to do the same thing, it seems.
Yeah. There's other examples. I'm look while you've been talking. I've been looking up to see if certain ticker symbols exist. Like soda isn't out there. That would be a great pivot for a company like Keurig Dr. Pepper, which is not had a Keurig, uh, which is a Vermont company, used to be a really good stock, but it's fallen on hard times lately. It is down. Let's see, last 2 years, it's down 18%. If they just went to soda, I wonder if that would help. If there's an upstart company that might challenge Novo Nordisk and Eli Lilly in the weight loss space, Thin could be a good ticker symbol. There's no food ticker symbol, maybe like company like Tyson Foods rather than
Yeah.
TSN. Could
Archer
be food.
Archer Daniels Midlands makes the majority, or made the majority as of 10 years ago, of store brands.
Yeah.
So your non-name brand stuff, like their ADM turn to food. Like Keurig Dr. Pepper, I like as an example. I drink one soda a day. It is a Diet Dr. Pepper. I'm very familiar with Keurig Dr. Pepper. I did not know their ticker symbol, KDP.
KDP. I know. Well, it used to be, well, Keurig was something. It didn't, I
It
think
was
Dr. Pepper was DPS at one point before they merged. Anyway, the fact that we don't really know tells you.
yeah.
Um, Here's one more pitch. I don't know if this would help or hinder. Um, if te if Tesla changed to Elon or Musk, that'd probably make it worse. But if Twitter ever came back, with him at the helm, maybe Elon or Musk would help. Because I don't know. Maybe he would hurt
I-
both. I don't really know.
yeah, he's become sort of toxic or
Yeah.
among some large demographic of people. With Twitter, I don't know. Do you do TWIT
Yeah,
or TW
TWTR was never a great one, I don't think.
tweet TWET maybe?
Yeah.
I don't know. Next time we run an IPO, we'll come up with a really clever ticker symbol, and we'll get a post IPO bump from it.
Yeah. Okay, let's move on to our theme, our um sort of big theme for today, which is leveraged ETFs, as you mentioned earlier. We'll talk about like sort of the pros and cons of using them. By leverage, I mean, ETFs that go up twice or three times as much as the regular ETF, that covers a certain subsector, a certain niche. Just talk a little bit about, sort of the pros and cons of using them, and is now the right time to use them in a bull market, but one where stocks are starting to pull back a bit.
Yeah, so this was prompted by research from a company called Vanda Research. They highlighted that retail investors have the highest level of leveraged ETF exposure since the May to July period of 2023, which is right when the AI narrative really started taking off. I remember when these products first launched it was right around the time of the Great Financial Crisis. So like '05, like '06, no, '09 maybe.
Oh wait, oh no,
Somewhere in the late 2000s. Direction or Direction, I never knew how to pronounce that.
neither do
Uh,
I. Yeah,
they pioneered them with some triple leveraged funds. You can get triple and double exposure to the S&P 500. You can get exposure to the NASDAQ Power Qs, exposure to sectors, as you said. Cannabis has leveraged ETFs, oil, gas, gold. You can gain exposure to pretty much any asset class you can think of. I will say that with maybe some of the more niche ones, you can run into volume issues. But what these are designed to do is move two or three times the daily performance of whatever the underlying sector or investment is. They even have leveraged bets on individual stocks now. You can get like Nvidia 1.5 times ETFs,
yep,
which just buy options, but I'll set that aside.
yep,
And what they do is they use a combination of equity and option positions to replicate leveraged exposure, and then they rebalance on a daily basis. And they are, if you are considering investing in leveraged ETFs, my first recommendation is pull up any leveraged ETF you want and look at a chart for the maximum time frame, because what you'll see is that they are all down. I think every leveraged ETF out there is probably trading below where it was initiated, especially if it's been around for multiple years. If it's
yep,
brand new, maybe not. But if it's been around for 2, 3, 4 years, it's gone through a bear market and it's gone through bull markets, then you'll see it down. And what they do is they tend to reverse split when the prices get really low to enable continued trading on them. They are good for directional markets when you have a very specific time frame in mind, and ideally when it's a short time frame. They are subject to a risk that's called beta slippage. If you have a market that is trading sideways, where it's going up and down and up and down, because of that daily compounding and the daily rebalance, you end up with, after an up day, you end up with more exposure. If the next day is a down day, you lose more. The math, and I'm going to do one quick bit of math. Tell me if you've ever traded the leveraged funds.
yeah. So I guess the one that it's like a perfect example right now is MSOX. which is a leveraged ETF that tracks the cannabis space. MSOS with an S, two S's, is the ETF that it's leveraged towards. It's 2 times whatever MSOS does. So right now, owning MSOX is a good play because cannabis has had a really good last few months, and the reason is because we talked about a lot here lately. There's all these potential catalysts in the hopper between rescheduling cannabis from class 1 to class 3 drug, which could happen as early as this month, depending on what the DEA decides. There's a Safer Banking Act in Congress that could happen before the election. We'll see. I think there's some pressure for that to happen. I think Germany just legalized cannabis. Florida Supreme Court just approved it
They
for
approved a ballot measure.
a
Yeah.
ballot measure. Yeah. And as a result, so MSOS, which tracks is just a non-leveraged ETF for the sector, is up 40% year to date. That's pretty good. MSOX, which is the leveraged ETFs, 2 times. MSOX or MSOS is up 64%. So it's not exactly 2 times, but you get the point. It's up a lot. So that's when you're bullish on a certain sector like cannabis, that's a time to use a leverage ETF. But they can be hard to stay in, as I found out personally, owning MSOX in the past, that you can get shaken out pretty easily.
Yeah, and that goes back to my big missed win yesterday, right? It's like you have to match your trading style to your risk tolerance to your underlying investment. The math that I wanted to do is something I used to do when I worked at Schwab when these were first coming out. If you have, let's say you have an underlying investment of $100. If that investment goes up 10%, it's now worth $110. Now, let's say that $110 investment, let's say it loses 9%. After you lose 9%, it goes back down to $100. So you're effectively flat. If, however, you buy a $100 3 times leverage investment, if it goes up 10%, you're at 130 because it goes 30% up.
Yep.
If you then lose 9% on it, you have more exposure to that magnified downside. And instead of going back down to your original investment of 100, you go down to about 95. So you lose 5% on your leveraged investment, despite the underlying asset being exactly the same in price, simply because of how these work. And I always use that. It's hyperbolic. Nothing swings 10% in a day, usually. I mean, sure, some stuff can, but in general, most investors are not going to be exposed to something that's got that kind of price movement. But that plays out and extrapolates over time. So if you're in something that's moving up, down, up, down, up, down, you are losing money because you've got more exposure to down days and subsequently less exposure to up days. So generally, they are a terrible, terrible long-term holding. You should not buy a leveraged fund as part of a long-term portfolio. If you are going to, it should be very directional. So the kind of market that we're having right now, where it's up only for 5 months.
Yep.
And you should be willing to cut bait, and you should also be targeting like the 2x funds instead of the 3x, because the more leverage you have, the more it's exacerbated. But in a strong trend, you can do it on more of an intermediate, even to a long term. Really, the directionality is the important thing. In a trending market, they'll actually outperform their stated goals of 3 times because you're compounding those gains every day. So they actually can do better. But as you mentioned with MSOX, it's up 62% or 64% versus the underlying being up 40%. That's because it's designed as a daily product and not a weekly or monthly product.
Right. And to your point, just on the trade, it being a viable trade on a hot sector, but not a long-term investment. MSOX launched in August 2022. It's down 81% since then, because cannabis stocks have been down. The only time it's been a good investment is really like the last maybe 6 months. So so there's others. I think you mentioned retail The leverage ETF is RETL,
Yeah.
SOXL for semiconductors. There are times to, strike while the iron is hot in those, and those going to be good leverage ETFs, but the opposite of a set it and forget it investment.
Yeah. So just to piggyback on that, if we look at having difficulty pulling up a chart. All right. If we look at SOXS, I got to use Yahoo Finance here. It is trading at 337 right now. And that's not working. Right. Sorry.
Well,
My
yeah.
apologies.
Anyway, it's a lot of math for one podcast, but yeah, I mean the point is well taken that I hope leverage ETFs. There's a time and place, but it has to be pretty specific, and you have to have them on a. I mentioned that I've gotten shaken out of MSOX a couple times. I don't necessarily regret that because that's sort of the nature of what makes them tricky, right? I think it fell at least 30% twice in the last like 6 months.
Yeah.
Overall, it's up, but that's I try not to let losses. I try not to take losses more than like 20% on anything. So, there's no exception with MSOX. So it's easy to get shaken out pretty quickly. But
Right, so,
you could be kicking yourself when it bounces back the way MSOX has. Sorry, go ahead.
So for SOXS, looking back over the last 10 years, it's down from a split adjusted 750,000 a share, trading at 337. For SOXL, which is the inverse of that fund, it's actually up $42 a share in the last 10 years at 44.08. All right, so yeah, over a long enough time frame, I guess if you get a big enough rally, and even looking at that SOXL, most of that performance has come since September of 2023, but not long-term investments. If you are looking at something that you have a directional bias on, but you're concerned is going to be choppy, you can actually use some of that slippage to your advantage by looking at, instead of going, say, long the SOXL, you can like look at the puts on the SOXS, right? Because they have the same directional bias. So you're benefiting if SOXL goes up, SOXS is going down. But if it does it in a choppy way, the beta slippage is actually working in your favor by grinding the inverse position lower. So there are smarter ways to play some of these. Generally, keep the position sizes small,
Yeah.
and make sure that they match your investment style and your risk tolerance, because they're uniquely risky, and they have risks that like a normal investment doesn't necessarily have, like that beta risk.
Yeah. I think that's a podcast. What do you think?
Yeah, I think we got to
Good.
call it that. We went so long up top.
Yeah, no, it's good. Yeah, we needed to talk about your big loss yesterday, or not big loss, big opportunity, missed opportunity yesterday. We really need to get that in there as essential. As always, like and subscribe if you're listening or watching on YouTube. You have a question, comment, complaint, maybe not complaint, street check at cabotwealth.com, suggestion for a future segment, anything. Thanks for joining us on Street Check, and we'll be back next week.